Good afternoon, ladies and gentlemen, and welcome to the Team Internet Group PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so on the Investor Meet Company platform. And before we begin, as usual, I would like to submit the following poll, and if you would give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to the management team from Team Internet Group PLC. Michael, Billy, good afternoon.
Thank you, Jake. So welcome everybody to the Team Internet Group 2023 year-end investor presentation. And I'm here today with Billy Green, our group CFO. And in the following, we are going to run you through this agenda. First, I will introduce you to the business profile of Team Internet Group. Then Billy will highlight or present the highlights of the year just ended and then do a deep dive into the financial results. Whereas I will then at the end take you on a journey through our strategy and outlook for the future. So Team Internet does two things. So we have this operating segment online marketing and the operating segment online presence. And in online marketing, we create privacy safe AI-generated consumer journeys that convert general interest media users into highly confident consumers. And in this business, in 2023, we've done a stunning $657 million of revenue from around 6 billion visitors coming to one of our 100,000s of micro websites that we operate. And at the bottom of the left-hand box, you see some of the largest brands that constitute this business. On the right hand, you see our online presence business, where we are a critical constituent of the global online presence ecosystem, where we serve as a primary distribution channel for a wide range of digital products, most importantly, exotic domain names, and we will come to that in a few minutes. Here, we've done $180 million of revenue from nearly 14 million domain years that we processed in the 12 months to the 31st of December. And again, on the bottom, you see some of the leading brands that are part of our online presence business. So why is now a good time to consider investing in Team Internet? And there are three reasons: growth, value, and timing. In terms of growth, we've ended the year again with double-digit growth, 15% to be more precise. And we are also very happy to report that both segments have almost perfectly equally contributed to the growth of the business. And still both businesses address the multi-billion market opportunity supported by industry megatrends. Then value. So for many years, we've consistently delivered high cash conversion of around 100%. We have a strong and well-capitalized balance sheet, and we've also more lately introduced a progressive dividend policy and started capital returns to shareholders also by means of share buybacks. And last but not least, in terms of timing, after a few years of build-up time, we have now firmly positioned our online marketing business in market as a market leader in the carefully curated niches that we have selected in this big industry. And the same also remains true for the domain business or the online presence business, if you want so. And going forward in both businesses, we will become more diversified and more vertically integrated. And these are aspects that we will address in the last section, strategy and outlook. Before we get there, let me back up our claims on growth and value with some data. So on the top of the slide, you see our pro forma revenue back to 2018. So for your convenience, we've added back all the acquisitions that we've done, as if you would have owned them as of the 1st of January 2018, to demonstrate the true underlying organic growth of the business, which reads as 25% over the last 5 years. There's, of course, 25% annually for the last 5 years. And at the bottom of the slide, you see that our free cash flow yield has materially improved from 6% in 2020 to now 14% in the year just ended. Again, these two facts together being testament to us being a growth stock and a value stock at the same time, just for the price of one. When we then come to the mega trends that float our business in online marketing, it is three. First, the ascendance of social media. Secondly, data privacy, and third, risk transformation. So how does this all play together? As you all know, today literally everyone has an account on Facebook, TikTok, X, Instagram, you name it. And below we are showing some of the user numbers that these platforms have amassed over time. And so today we can consider social media, and with it user-generated content, as the main form of media consumption on the internet. Yet at the same time, the advent of data privacy is a trend that we strongly endorse. Monetizing visitors to social media websites has become incredibly challenging. And this is where our secret key comes in to unlock this opportunity, which is risk transformation. So where we convert clicks on social media into more valuable clicks related to search ad campaigns, and clicks on search ad campaigns into actual e-commerce transactions. And we will present to you how we intend to build this business further in the last part of this presentation. So please stay tuned. Then on the online presence side, it is again three mega trends. First, optimizing for efficiency, then the move towards exotic domain names, and last but not least, our commitment to excellence. And efficiency is the raison d'être, the reason to be of our business. So just imagine 4,000 companies being licensed to sell domain names to the general public, and 1,500 different top level domains, like, of course, everyone knows .com, .net, .org, .uk, .de, .ch, but there's 1,500. If now every registrar wants to sell all the top level domains, you would need 6 million technical integrations, 6 million contracts, 6 million monthly bills. So here there is clearly a case for a clearinghouse, which dramatically decreases the complexity of this industry, or augments and enhances its efficiency. And we are a firmly established part of this very small oligopoly of such clearinghouses. Number one in Europe, number two in the world. And why is this so relevant? These clearinghouses naturally have a particular role to play in the realm of country code top level domains. And country code top level domains are the fastest growing segment in the market. Why is that? Under .com, the most popular top level domain, most reasonable combinations of letters and number have already been taken. This is why the operator is switching to price increases for further revenue growth. Yet from a customer perspective, this makes that there's less attractive inventory for higher prices. This is why more and more often customers opt for their local top level domain, like an English business might go for .uk, or they opt for so-called repurposed top level domains like in .ai, which stands for the island of Anguilla, but of course is now being understood as artificial intelligence and is selling like hotcakes. The other examples like .io for the British Indian Ocean territories, which resemble a 1 and a 0, or input and output, so attracting any kind of digital business, or simply .co for Colombia as a hip alternative to .com. And so we are by nature firmly positioned in this most attractive subsegment of the domain industry. However, we are so successful in this business because of our commitment to excellence, where we have clearly set out and publicly communicated service level agreements and customer success KPIs, which we not only consistently track, but we also consistently surpass them. And our Trustpilot rating of 4.6 out of 5 is testament to this fact, putting us very firmly at the very top end in terms of customer perception in this industry. And then over these two segments, we created this vibrant and symbiotic ecosystem connecting companies on the supply and on the demand side. And we are truly in the fabric of the internet economy, with having the most reputable and leading companies on both sides of the equation. So on the supply side, we have companies like a ByteDance, a Meta, a Taboola, an Outbrain, or if you go to the domain business, companies like Verisign or Nominet. And then on the demand side, we then have, again, the top brands on this planet, like a Google, a Bing, a Yahoo, an Amazon, or if you go to the online presence side of the business, companies like a GoDaddy, a WordPress, or if you go into the corporate subsegment, companies like Johnson & Johnson or Mercedes-Benz, again, being testament to our stellar and pristine reputation in the industry, allowing us to trade with literally everybody on both sides of the fence. So this is what Team Internet Group does, and my colleague Billy will now present to you how this has translated into financial success. Thank you, Billy.
Thank you, Michael. So just giving you a brief overview of the main financial highlights of 2023 for us as a group. You'll see across the top row of boxes there that we continue to deliver, as we've consistently delivered before, double-digit growth in many revenue and profit metrics. The growth of 15% in gross revenue, right through to the growth of 26% in operating profit, being testament to the sustainability of the revenue and profit journey that we as a company continue to pursue. One factor that's particularly important to us when it comes to not only looking at being able to drive the company's revenue forward, but also being able to convert that revenue into an ever higher level of operating profit. We set ourselves a metric internally of monitoring our EBITDA conversion. So that's adjusted EBITDA divided by net revenue. And you'll see that whilst for 2022, we still remained at lower than 50% conversion of net revenue into adjusted EBITDA. The 86 million divided by the 177 million you'll see in front of you here, for the first time in 2023, we achieved a higher than 50% conversion of net revenue into adjusted EBITDA. 96.4 million of adjusted EBITDA being generated from the 191.1 million of net revenue. And naturally, having now got through a 50% level, the bar is raised for us both internally and externally, and we expect an aim to deliver a higher than 50% EBITDA conversion every year prospectively. And that profitability flows right the way down the P&L. We'll have a look at slightly deeper dive on the income statement in a few slides' time, and you'll see that profit story goes right the way down the P&L. At the bottom left-hand corner of the screen, you'll see our adjusted earnings per share increased by a factor of 34% from 2022 into 2023. That EPS growth being driven, of course, not only by the higher earnings year on year, but also the reduction in share count that we successfully executed during 2023 as a result of our 2 share buyback programs that we ran during 2023. The net debt of the company continues to be at a very manageable level, having delevered significantly and rapidly in 2022 to a level whereby we got to 56.6 million net debt as of the end of 2022, and that was significantly less than our adjusted EBITDA for the year. we remain in 2023 at a less than 1-to-1 ratio, less than 1 turn of net debt compared to adjusted EBITDA, at 74.1 million net debt compared to 96.4 million annual adjusted EBITDA. And therefore, that's a level at which the net debt remains very, we consider that we're quite moderately levered, and we're certainly nowhere near the levels of leverage we were at in 2020, 2021, when we had more like 2.5, sometimes even higher turns of net debt compared to adjusted EBITDA. So in a couple of slides time, I'll take you through the component parts of what the 74.1 million consists of, or where it's come from, but it remains at the level at which we targeted, which is to remain well below two times net debt to adjusted EBITDA. In fact, it's below 1 times net debt to adjusted EBITDA. So confident are we in the strength of the balance sheet and the continued financial maturity of the group that, having declared and paid our inaugural dividend of £0.01 per share in Q2 of last year, we're proposing to our annual general meeting this time next month that the shareholders vote to double the size of that dividend to £0.02 per share, payable in Q2 24 in respect of 2023's financial performance, reflective of the company's continued profitable growth. Taking a slightly deeper dive on the organic revenue growth for fiscal year 2023, you'll have seen the as reported growth levels continue to be at a very pleasing level. It's important to us that we stay in tune with the actual real underlying organic growth levels of the business. And those of you who've seen this graphic before, you'll know that the very small green sliver at the top of the blue bars represents an adjustment to pro forma the results both for 2022 and for 2023, as if all the constituent parts of the group were present consistently throughout the entire period from January 22 through to December 23, and also at a constant currency rate, as if there had been no foreign exchange fluctuations in our numbers. So it gives you a true like-for-like comparison of the business, indicating the true real underlying organic growth rate. And you'll see that even after adding back for acquisitions and constant currency adjustments, mainly of course impacting the 2022 numbers, because we have been somewhat less acquisitive over the course of late 2022 and into 2023, and therefore there is a smaller delta between reported figures and pro forma organic figures than you may have seen in previous quarters. But we're still showing organic growth of 12% on the online marketing segment and of 16% in the online presence segment, a testament to the underlying strength and health of the business. On the right-hand side of this screen, you'll see some of the key performance indicators that we have become accustomed to presenting to enable people to understand a little more about which parts of the business are really flying and where the profitable growth is coming from. You'll see that our volume metrics continue to trend in a very positive direction, both on the online marketing and on the online presence side of the group, so that even in a year where RPMs, so revenue per thousand clicks, which is a metric, revenue per thousand views, even in a year when that price metric on the online marketing side of the group is lower in the current year, 2023, than it was in the prior year, 2022, which was a real boom year for click prices and for advertiser competition. Even in a year where we're seeing lower click prices and quite objectively lower consumer confidence and lower competition between advertisers, we're still able to take the group forward profitably. We're still able to grow revenue and indeed grow all financial metrics, so that we're showing that even in a time when many of our peers and business partners, unfortunately, are experiencing difficult times economically, we still go from strength to strength, and we still grow both in terms of revenue and profitability. So there is nothing for us to be afraid of in terms of future seasonality or other macroeconomic trends that impact the online marketing industry. We can trade profitably whatever the market conditions show, and indeed we're not directly reliant on RPMs increasing in 2024, although of course any factors within our power that we can do to improve click prices we will of course take. but the growth in volumes of our business, the commitment to excellence, the launching of new products and technological innovation all point towards a business that is able to trade through whatever the market conditions are, so that even when the online marketing industry is cyclical, we continue to grow and to be successful. I alluded earlier to the second share buyback program, which we launched in Q2 of last year. There was a smaller buyback program launched on 30th December 2022, which then concluded toward the end of January 2023. Following the success and popularity of that of that more modest share buyback scheme earlier in the year, we then launched a more expansive program in Q2 of last year, and we're now reaching the conclusion of that second program, and it has again been very, very successful in achieving its goals, its aims. Taking a slightly deeper dive in respect of the income statement of the business, most of the top 2/3 of the P&L, from revenue down to operating profit, we've already highlighted in terms of very clear and strong financial metrics. But right the way down the P&L, right down to delivering a profit after tax of $24.3 million, we're very, very pleased to be able to report such a significant profit after tax. The company has gradually, over many years, moved away from losses before tax into a position where we nearly achieved a profit after tax in 2022. We had a slightly higher level of amortization of intangible assets in 2022 as a result of the acquisitions that we had carried out. So we were at nearly a break-even position after tax in 2022. So from now to convert then to a mega double-digit million profit after tax in 2023 of 24.3 million, that's a good position to be in, and it indicates the financial robustness of the company. Naturally, though, the next challenge for the business is every year we post good results, we then need to grow and record even better results in the successive year. And I'm very happy as CFO, and we're very happy as a leadership and a management team to grasp the mantle and to ensure that we set ourselves the target that, having achieved 24.3 million profit after tax for 2023, we then need to deliver even higher profits after tax in successive years. Moving on to the balance sheet strength, I did say we'd come back to net debt in a little more detail. And as a reminder, following quite rapid delevering in 2022, so we arrived at 56.6 million of net debt at the end of 2022, which was significantly lower than the adjusted EBITDA for that year. Most of, or certainly greater than 50% of the free cash flow that was generated in 2023 was then used to return cash to shareholders in 2023 by way of the share buyback programs that we've described, and also the inaugural dividend, which was paid in June of 2023. So that's a combined $44 million of cash returned to shareholders in 2023 alone. So that excludes the start of the first share buyback program in 2022, and also excludes the continuing share buyback program we've been running into 2024. The increase in net debt is basically primarily the result of us experiencing in 2023 a higher than usual and unprecedented and never to be repeated, based on the current portfolio of businesses that we own, a high level of earn-out payments, deferred contingent consideration payments, which we've paid to the former owners, founders of businesses we've acquired, in recognition of the absolutely stellar growth of those businesses since they joined our group. So they have, in most cases, overachieved the targets we set when we acquired them, and therefore we had fairly material payments of $22 million in Q3 of 2023. But it is worth reiterating that is not a recurring cash outflow. We do not expect to experience anywhere near the same level of earn-out payments based on the current portfolio within the group. So if you were to add together, as a mathematical exercise, the $44 million of cash returned to shareholders and the non-recurring level of deferred contingent consideration, you get to $66 million. And you'll see that absent those two factors, $74.1 million of net debt at the end of 2023 could quite conceivably have been much closer to a zero, i.e. a net cash situation at the end of 2023. So it is perfectly within the company's control to manage that net debt level and to get close to net debt if that is the wish and the will of the market. At the current time, we've seen it as particularly good value to return cash to shareholders by way of the share buyback, but we do have it completely within our control to either return cash to shareholders or to manage the net debt levels, depending on what we as a board conclude is the most appropriate way to take the business's capital structure forward, and in line with and very clearly consistently with the cash waterfall, the cash allocation program, which we announced this time last year and continue to stick to absolutely consistently. The final comment I'll make on the financials before I hand back to Michael is those of you who followed Team Internet or Central Nick as it used to be known for many years will have seen that we consistently strive to convert operating profit to operating cash at a level of at least 100%, so higher than 100%. And having overachieved that goal in 2022 and achieving 110% cash conversion, operating cash conversion in 2022, we achieved slightly lower than that target in 2023 of 96%. So close to 100%, but not the level at which I would task the business to perform in 2024 and beyond. So we go again in 2024. We have set ourselves a target of 100% plus in 2024. And I'm very confident that we will achieve cash conversion of more like 100% plus in 2024 and in prospective years. And with that final comment on cash, I'll hand back to Michael for an update on our strategic outlook.
Thank you, Billy. And I hope everyone on this call is just as excited about these results as I am. And let's now have a look at what we intend to do to keep it that way. And our main strategic priority is creating a virtuous circle. The virtuous circle starts with a laser focus on organic growth, winning new customers, and constantly launching new products that exceed our customers' expectations. That organic growth, combined with our disciplined approach to cost, then leads to operating leverage. Billy just mentioned that for the first time, we've converted more than 50% of our net revenue into EBITDA. And just for memory, only in 2021, that ratio was only 39%, just demonstrating the huge levels of operating leverage that we've already demonstrated. And the operating leverage with the operating leverage then again translates into more competitive cost of capital. So here we had a major crystallization event back in 2022 when we refinanced our bonds. It was also on one of Billy's slides where we've cut the credit spread applicable to us by more than 50% from 7% to 3%. And this is also the reason why in 2023 and also this year we are turning our attention to the cost of equity, hence the progressive dividend policy and the share buyback program. And then the competitive cost of capital allows us to do focused and highly accretive bolt-on M&A. And while in 2023 we've taken a bit of a hiatus from M&A, it is still a strategic priority of our company, because then each acquisition leads to new adjacencies on the demand and on the supply side, and then adding new fuel to the organic growth engine, which then becomes a virtuous circle. So how can we further enhance our business model? So in the online marketing business, which has within a very short period of time grown into our largest business, everything starts with a click. So today our two main businesses are taking that social media click and converting it into a more valuable click in a search ad campaign. And then through the acquisition of Vergleich.org in 2022, we added another skill, which is taking a search ad campaign click and converting it into an e-commerce transaction and earning a commission income on it. Our plan now for 24 and later is then to add another model, basically inversing the principle, rather than converting one click into a more a singular, more valuable event. We want to take clicks and convert them into a stream of revenue generating events by building content websites with highly captivating content on them. A typical example could be the best 100 US colleges, where you start on rank 100 and then have to scroll through. And as you scroll through, we then constantly deliver new ads to the user, basically going from a one-to-one model going to a one-to-many model. And these kind of models work particularly well in verticals in which Team Internet is currently underrepresented. And this is why this step will enhance our total addressable market and also introduce a new tool in order to extract even more revenue and both for our customers and for our shareholders. So this is now the immediate step that we plan to implement in 2024. If you think there's a little bit more long term, it becomes our OM Square vision. The OM Square vision stands for Omni Media, Omni Monetization, where we intend to build an ecosystem that can absorb traffic from any kind of source, whether it is a social media website, a search engine, or a content discovery network, and feed every user into the right monetization channel, whether be it our main search engine partner, a direct advertiser, or an e-commerce affiliate. And new product announcements that we would make, or any acquisition that we would make in the online marketing division, should be understandable even to a layman how they fit into this scheme. So you can always use this as a compass to understand how a specific strategic action that we've been taking fits into our long-term strategy. If you then elevate this one level higher to the entire group level and to take an even longer perspective, let's say 10 years, how will Team Internet then look like? First, it will be more diversified in terms of its revenue streams and its supply sources. Secondly, it will be more vertically integrated with the objective to keep more of the value that we create in this industry to ourselves, and also reduce friction losses in the industry. Third, in everything that we do, we aspire for global leadership, and in the carefully curated segments in which we operate, we stand up very well to that claim. And in everything that we do, we remain firmly rooted in our core values and beliefs that we presented at our Capital Market Day in September last year. And one of these beliefs is to build products that we are proud of, to build products that exceed our customer expectations. And here AI comes into play. AI has always been seamlessly woven into the fabric of our daily operations. However, we have now created a more formal program with three main pillars: raising the floor, raising the ceiling, and raising awareness. Raising the floor stands mostly for doing the things that we have always done, but notably more efficient, whether that's in HR, in sales, or any other internal function. Raising the ceiling then means allowing our senior engineers to harness the power of AI to build augmented products which exceed our customer expectations even further, basically taking the products that we have today and making them even more powerful. And then last but not least, raising awareness stands for getting understanding how artificial intelligence could actually disrupt business models that exist today, and to build the products that were simply inconceivable before the advent of AI. And here, some recent examples are our new advertising product, Absolutely, which is an ad format that automatically learns in which kind of content it has been placed and optimizes itself for it. Or our fully automated content publishing business that understands the topics associated with a domain name, writing articles, matching that domain name, and even subscribing to news feeds to then later write new articles based on news around the topics the website is about, to constantly stay alive. And it would even go so far to publish these articles on social media. So basically everything that a classical media business would do, just being run out of a box. And with this, with the strong financial results of 2023 and this culture of excellence and innovation that we are instilling at Team Internet, the directors are pleased to confirm that they are confident in the company's ability to meet its market expectations. And as Billy has laid out, with the high cash reserves that we have, the strong operating cash flow, and the committed credit facilities, the company is fully funded to simultaneously execute a strategy to invest into its future and also to return cash to its shareholders. Hashtag doubling the dividend, hashtag share buyback program. And yet again, as a commitment of the executive committee, the group aims to become more diversified, more integrated, and incessantly pursue its global leadership aspirations. Thank you very much, and we are now open for Q&A.
Perfect. Michael, Billy, if I may just jump back in there, and thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Billy, Michael, as you can see there in the Q&A tab, we have received a number of questions from investors, and thank you to all of those on the call for taking the time to submit their questions. But Michael, Billy, if I may just hand back to you to read out those questions and give your responses where it's appropriate to do so, and then I'll pick up from you at the end. Thank you.
Yeah, that's appreciated. Thanks, Jake. Starting to see the questions coming through on quite a few topics which we alluded to in the deck, and now people want us to expand on, which is good. So the first question I can see here is whether we expect to see more share buybacks in 2024, taking you from the very objective fact that in 2024 we are buying back more shares right now as we complete the second buyback program, which we launched in Q2 of last year, but then taking you from the most objective to then what we aspire to do. We will also, as a board and as a management team, we will propose at the company's forthcoming annual general meeting next month. We'll propose that for another year, the company's shareholders give the company authority to buy back up to 10% of its share capital, which will then allow us, it will give us the capacity to engage in more share buyback activity, subject to availability of funds and subject to us ensuring that that's balanced against all the other needs of the business. So once we receive that authority, one should anticipate that share buybacks will be another high priority again for the company in 2024. But naturally, we can't commit today as to what the level, the materiality of that share buyback program will be in 2024. Only that we continue to commit that our capital allocation will remain completely consistent with the waterfall, the cash allocation waterfall, which we initially published this time last year, and reiterate and republish today in the annual report we released, that our allocation priorities will be to pay our dividend, to reinvest in the business, to engage in M&A activity where it makes sense as a business and where there are opportunities that are available, and then to allow cash to be available for buying back shares, and ultimately, once there's share buyback activity, also to manage our debt as well. So sorry if that's a rather long-winded answer, but we have to be careful that we don't give a definitive answer when it is not our place. It is the role of the shareholders, first of all, to give authority for the company to continue buying back shares after the current program. And then there is a broader board beyond Michael and myself who will then determine the actual detailed strategy. The next question I can see here is also share related. Have Kestrel informed us of their long-term plans as a major shareholder, and how much influence do Kestrel currently have? In terms of Kestrel's long-term plans as a major shareholder, those of you who follow the stock in detail will see that Kestrel have continued to add to their shareholding over the last year. So Kestrel continued to be a welcome and significant part of our shareholder base. In terms of the influence that Kestrel have as a business, as you'd expect with any shareholder that owns more than 5-10% of a business, Kestrel are active in terms of guidance and advice that they give to the remainder of the board and to a management team. But it is also worth bearing in mind that Kestrel are quite a long way from being anywhere near a majority shareholder of the business. We have good liquidity as a group, and Kestrel exercise no more influence than any other major shareholder. The next question I can see is slightly more related to the financials. Why does the company continue to endure significant interest expense if, as it appears, it is possible to reduce the borrowing level, which it is? We can reduce the borrowing level by repaying some of our revolving credit facility. The share buyback has no such immediate saving of costs. So this is a really interesting one for us strategically. We considered during 2023 and continue to consider that from a cost of capital point of view, buying back shares represents better shareholder value than paying back some of our debt, particularly when our net debt and our leverage remain at considerably lower levels than we experienced in 2020 and 2021. We do recognize that there's going to be a variety of market views on the relative value of buying back shares versus paying down debt. While debt remains at what we believe to be relatively low levels compared to what we've seen in the past, buying back shares has represented very good shareholder value in the last year or so. And whilst that doesn't necessarily save P&L cost, we have to consider that the overall perspective of what's going to generate the most additional shareholder value, which we consider to be buying back shares. And as that share buyback program continues, we naturally take on board the tenor of this question when we consider what our capital allocation strategy is and how it's going to be executed in 2024 in line with our cash flow waterfall. The next question that's come up is, do you expect the number of visitor sessions in the online marketing segment growing at the same rates in 2024 as those seen in 2023? This is quite subjective in terms of how we expect the volume metric to grow. I don't know, Michael, if you might have a closer view on that than mine.
Yes, and the expectation should be that the number of visitors will systematically grow faster than the dollar amounts, given that we're also seeking growth in emerging countries. So, and for example, in a country like Indonesia, click prices are notably lower than, for example, in the United States. And if you see growth in emerging markets, you will always see an overproportional growth of visitors as compared to the US market.
Certainly. So the next question that's come up is, why is the share price so depressed and range bound given the growth, future opportunities and free cash flow yield? It seems very low. That's an observation that is obviously quite subjective. In terms of the share price, I don't feel that it's either Michael or my place to give too many subjective and opinionated views, even though, of course, every individual will have views as to what drives the share price. All we can do as a management team is to continue to execute very well on our business plan and deliver excellent results. There are a couple of factors that I would imagine a range of investors will look at in terms of the performance of a company. For me, the fact that we declared and paid our inaugural dividend in 2023 And we have not only in 2024 growing that progressive dividend policy, but indeed doubling the dividend. I think that's a sign of the company's financial maturity, financial stability, and I hope that the market will respond well to that. Likewise, for me, the achievement of a significant profit after tax, i.e. real objective bottom line profitability that is objectively adding shareholder value, that's also something that there will have been parts of the market that did not like that about the company in the past, that the company didn't necessarily generate a bottom line profit. So now that we have generated not just a small break-even bottom line profit, but $24.3 million, a huge amount of money. I mean, the entire adjusted EBITDA of the group was less than that when I joined the group in 2019. And Michael and I, as a management team and as a director team today, we started talking many years ago about the company's journey towards achieving sustainable profit after tax. So now that we are in a more objective place in terms of delivery of profit, I think there's much more for all levels of investors, from right up to the very sophisticated investors, to really like about this stock. And I would also reiterate and draw people's attention back to the growth and value and timing aspects that Michael presented earlier, which is available in this investor deck regarding what it is about the company that's great to like. There's a lot in there, and there's obviously a lot more that we're happy to talk to individuals about in order to make those growth, value, and timing factors even clearer. The next question that I can see here is one that we have been asked in the past. Is there any benefit in splitting the online marketing and online presence segments into separate listed businesses? And it's another quite subjective question, I would say. The online marketing, online presence businesses look quite different in 2023 and into 2024 than they looked this time last year, because this time last year we were seeing online marketing continue to grow at progressively higher rates and becoming a much larger proportion of the group than online presence. We've seen a slight narrowing of the internal competition. It really is a competitive management set we have internally, and we've seen online marketing and online presence grow at quite similar mid-teen rates from 2022 into 23, and certainly our forecasts and estimates show those businesses growing at more similar rates in 24 than we experienced in previous years. So right now it looks like the growth rates of those businesses are quite complementary. We would also feel that although there may at some point in the group's future be more objective benefit in looking at these businesses separately, this would not be a good time to split off either part of the business. It's not a particularly welcoming time to list to IPO at the moment. So from a timing point of view, it's probably not a very good time at the moment to split online marketing and online presence. But as a management team and as a board, we have to be responsible to the shareholders and have to be open to that possibility at some stage in the future. So I would not rule it out, but the timing isn't right at the moment. The next question I can see here: growth has been very impressive, and don't get me wrong, it's still impressive, the question says, but it also has been slowing at a net revenue level, even if gross revenue continues to increase. And the ultimate question is, what will drive future growth, and what levels of growth should we be expecting in future? It's quite important that we remain fairly conservative in our forecasting, as we have been in the past, and we certainly would not claim that we are likely to see material increases, or we wouldn't guarantee to see material increases in click rates, and therefore wouldn't guarantee that one could see more like mega double-digit growth in the online marketing segment in 2024. But we do expect and should see continued growth, continued double-digit percentage growth in online marketing and online presence in 2024. That has been the consistent delivery of the company over the last several years. And even though there may be macroeconomic factors which we are waiting for them to turn into our favor, there are many, many actions we're taking on the product development, technological expertise side of things that are indicating that that the levels of growth in future should be not materially out of step with the very impressive levels of growth we've delivered in the past. But to reiterate what I said at first, we continue to be very prudent and conservative in our forecasts, and we certainly wouldn't want to guarantee that future performance will be in line with previous levels of growth. It's just we have a plan as a business to continue to deliver at that rate. The next question I can see is more related to the financials. Why was the tax charge so high in 2022? I do remember answering questions a few times about the 2022 tax charge when we had these equivalent calls this time last year. There are a couple of factors, one of which is a permanent factor in the business, one of which was temporary in 2022. In order to look at the tax charge as a percentage of profit before tax, or rather to look at the tax charge as a percentage of earnings subject to tax, you really need to add back most of the intangible asset amortization, because that generally relates to amortization of businesses we acquired over the years through M&A activity, and therefore that's not deductible for tax in most jurisdictions. So if you're going to look at the effective tax rate, you should add back that intangible asset charge, and you'll see from that point of view the tax charge, whilst it was higher in 2022 than other years, it's not out of step with other years. The other point I would make in terms of the tax charge as we see it at the moment, it's important that anybody who's looking for an indicator as to what the future tax charge is going to be, look at the tax note in the accounts and decouple the current tax charge from the deferred tax charge, because we experience and obviously we're quite happy to pay tax in the jurisdictions in we operate as we generate profits, and as a responsible employer and a responsible part of the tax ecosystem, we do pay taxes as they fall due, but the current tax is slightly offset by deferred tax credits, and one cannot guarantee that the deferred tax credits will recur in the same value in future years. So please do decouple the current and the deferred tax, and we can obviously help people to do that in order to arrive at a sustainable level of effective tax rate for future years. The next question is one which I'll pass over to Michael, and that question is, who are your main competitors in terms of your pursuit of global leadership?
Right, and so in our tonic business, this would be names like System One Incorporated, or the CEDO division of Ionos, who are or the Ask Media unit of IAC. So these would be probably the largest companies. And in our Vergleich.org business, we would then rather compete with other national champions, like, for example, Idealo in the German market. But again, here our ambition is very much growing the business through internationalization. And in 2024, we plan to enter way more markets than we did in 2023. And then again, in the online presence segment, it is Tukaus, respectively the Tukaus Domains division of Tukaus Incorporated, who are today the number one on a global scale. However, as we've shown in prior investor decks, we are catching up to their position at a relatively fast pace, and clearly have the ambition to take the number one spot in only a couple of years from today.
Thanks, Michael. The next question I can see is, please can you comment on the 2023 amortization of intangibles and tax charge figures, and how we might see these items develop over the next year or two? So the tax charge I briefly alluded to in the previous answer I gave, that I'd be very careful to guide people towards looking at the current tax charge and looking at the deferred tax charge separately. So one can't guarantee that the relatively low level of tax charge experienced in 2023 will replicate in future years in terms of applying that as an effective tax rate, because the deferred tax credits that we benefited from in 2023 will not necessarily recur in 24 and beyond. So with the tax charge, I would expect to guide all users of the financial statements to look at current and deferred tax separately. In terms of the amortization of intangibles, that number has gradually trended up, certainly since I joined the company in 2019 and even before. But based on the current portfolio of companies within the group, i.e., until and unless we are more acquisitive again, one might see a drop-off, a gradual tail-off of that amortization of intangibles numbers over the next year or two, as some of the businesses we bought 5, 6, 7 years ago reach the point where they're at the intangible assets which were set up when they were acquired become fully amortized. And therefore, when we've had some fairly significant chunks of amortization each year for businesses we bought dating right back to the acquisition of KeyDrive in 2018, so nearly 6 years ago now, one could see, and in fact, of course, we model out our amortization charge, one could see a reduction in that charge absent any subsequent M&A activity which we might engage in, which would, of course, then add to a higher level of intangibles. So based on the current portfolio, I would not expect an increase, but that can obviously change depending on how active we are in the M&A market this year. The next question is about, can we provide some information on trading so far this year, please? And generally, the answer is we are not able to provide much information about trading so far this year. Reaching the Q1 point of each year, when we release our annual report, we typically we're pleased and confident to state that we'll be meeting market expectations, and we continue to find ways in which we can sustainably grow the business. But Q1 trading information will have to wait until we release our Q1 results in May. 2 months from now. In fact, by 2 months from now, we will release our Q1 results. The financial calendar comes around very quickly this time of year, because by the time you get your annual report out, which for us is a week earlier than we've ever released before, it still is quite a narrow time frame until our Q1 results are out. So people won't have to wait too long to actually see how Q1 has been and how we're trading as a business moving into 2024.
Right. And again, we deliberately, by choice, report quarterly, which basically just adds to our commitment to transparency. And people should also remember that Q1 is not really the decisive quarter. It's every year we make most of the money in Q4, so that's really the quarter to watch out for. And again, today in 8 weeks you will have a Q1 report in your hands.
Absolutely. I think that pretty much brings us up to time, Jake. Do we have time for another question, or are we likely to overrun?
You have the floor for as long as you need, sir. If you do want to address those final questions, then please feel free. If not, we can give you all of the questions back immediately after the presentation has ended for you to review as well. Okay.
Well, let's answer one more question then. There's a question about the share price, which we alluded to earlier. I think the final question then that we'll answer, there's a question here: what drove online presence growth, and is this sustainable into 2024? And in short, well, the drivers of online presence growth, I would refer you back to the mega trends that Michael went through, particularly the online presence slide there. There were 3 bars indicating why online presence, or the domain name industry as a whole, is benefiting from macroeconomic mega trends, which we then take advantage of, and then specifically our commitment to excellence within online presence, and as reflected quite objectively in our 4.6 out of 5 Trustpilot score, indicate why we are successful within that space. So please do revisit that megatrend slide when you have the opportunity to do so. The investor deck will be available. Is this sustainable into 24? More subjectively, we do strongly believe that we can continue to grow online presence at a double-digit % growth rate, which hasn't necessarily been the case in the years 2022 and prior, but having demonstrated in 2023, in the face of quite a few commentators who could not believe that an already successful, established, steady-state online presence business could be grown at a double-digit rate. We did so in 23. The same factors are in place to deliver into 24 as well. There's a full year impact in 24 of some very successful launches and business decisions we made in mid 23. So that gives us good tailwind into 24. And naturally, it's our responsibility as a management team to ensure that carries on beyond 24. So very bright times ahead for online presence and online marketing. Likewise, we continue to provide revenue and profitable growth, and look forward to continuing to deliver and hopefully delight all sectors of the market in 2024 and beyond.
Perfect. Michael, Billy, if I just jump back in there, thank you very much indeed for being so generous of your time and addressing all of those questions that came in from investors. And of course, we will be able to give you back all of the questions that were submitted today, as well as any further ones that do come through back immediately after the presentation has ended, just for you to review, to then add any additional responses, of course, where it's appropriate to do so. And we'll publish all those responses out on the platform. But Michael, perhaps before really just looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that would be great.
Yes, thank you. And again, we are delighted to have ended the year 2023 on such a high note. And we're also excited by the amount of interest that our company draws, just seeing the number of questions coming in as a token of evidence. And we made a particular amount of effort to really have a very comprehensive annual report, which is available for download, where we talk in length about the specific strategic trends that we're addressing, how we're addressing them, what the drivers for success are. So I hope I can motivate you to download a copy of the annual report and read through it. I believe it is one of the more interesting reads being published by public companies.
Perfect. Michael, Billy, thank you once again for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure it will be greatly valued by the company. On behalf of the management team of Team Internet Group PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.